Welcome to TMS Insights. It's late July. We're giving you a bit of an update now, Ben, ahead of reporting season, which comes around in August. Normally we bring two reports to you through August about what the results are. Today we actually wanted to give a bit of a preview and explain what actually happens in reporting season as well. Just looking at the end of financial year to begin with, Ben, obviously it was a pretty good year for the market overall, and now the next bit of guidance will come from these results.
Yep, I think the market ended up delivering about a 14% return for the financial year, so that was one of the better ones. I would say it sort of bottomed out and then in the end of June 22 and then retested that in December, and then obviously we've been led mainly by this big rally in US technology shares in the US market. So it's been a good year. It's been quiet recently. There hasn't been a lot of company-specific news, but that's about to pick up quite significantly as we digest a lot of results.
Yeah, okay. So for the benefit of everybody, reporting season is largely for the financial year, full year ended 30 June. So we hear most from those companies. Some of the half-year results, and not every company reports because their year-end is different. Yep. We get their preliminary final report, their audited annual report comes out later, and we get an opportunity to hear and eyeball management, don't we? So it's one we don't want to lose, and it keeps us pretty busy through the month of August.
Yeah, and probably just giving, because we often talk about what the outcome of it was, and maybe we haven't in the past really talked about what we do during it. And I guess our sort of process leading into it firstly is to give ourselves an update. We get a lot of research from all the different brokers, and it's to get a feel for what different analysts are looking for and where their expectations lie and what are the concerns or the opportunities that they see in different companies, and sort of freshening up on that leading into it. On the day of a company's result, and I'd say we've got 25 odd companies that we own on behalf of clients.
And we keep a really active watch on.
There's probably another 30 that we've got an interest in, but maybe not there at the moment, but want to keep getting updates from them. And then there might be some over and above that. But there'll be a presentation that's released to the exchange, and but then, as you said, where you get the most value is actually trying to hear from the CEO, the CFO, and related execs, what the numbers look like. Actually, there's always, the other thing that happens is wild share price reactions to the results.
That's certainly one thing we want to explain, because it's all about the role of expectations, isn't it? So we go in expecting a number, let's call it $100 million. If it comes out at 96, whether it was up 20% on last year or not, it'll disappoint the market and it could cause a reaction. Negative one often, but sometimes the reactions are unpredictable.
The reaction sometimes could be, we thought it'd be worse than that. And you can actually see on what on face value looks like potentially bad news is actually sees a positive share price reaction. But I think the main thing that you're wanting to do on that day is to hear from the management themselves what is going under the bonnet of the business, and where they're feeling pressures, where they see opportunities, but also to get your head around, if there is an issue, is there a reason behind it that's probably non-repeatable, or is it a warning sign to us that we should be really looking at it?
And so that's part of the fact that we're probably less interested in that half an hour, 1 hour, 1 day reaction than what it means for the long term. And opportunities could be thrown up by that share price movement. But we used to do this in person. We still do them sometimes, but obviously the capacity of video calls, teleconferences give us the ability to get across quite a few, which is good. But we also have the benefit of the team here at TMS, which does a number of them, because some of those days are really heavy, aren't they?
Oh, yeah. I mean, look, the first couple of weeks, there's a slow build-up, and REA is typically our first company that reports on about the 7th or 8th. The last 2 weeks, for whatever reason, is just this onslaught of news flow, and it is. So that certainly different team members here will listen to different results and take notes, and we'll sit down and talk about what they heard, and we can go back and re-listen to some of those presentations. As you said, ideally you want to be in person, so you really got to pick your ones that you go along to, because it does take a bit of time, but you get a lot of value out of it. And you can always catch up on other ones later in the day.
That's it. Some do a roadshow after the presentation, so there's that face-to-face opportunity. But maybe talking to this results season. So a year ago, we saw a very strong increase in EPS, and last year was a positive year for the market. Now, getting a read on this season early is interesting. Earnings, which were up 15% a year ago, maybe flat for the financial year 23.
Yep.
What's that going to mean for market reactions?
Well, there's this very well-known narrative now where everyone's wary of stocks that are exposed to the consumer. As the consumer has tightened its belt through the first half of this calendar year. A number of CEOs in different businesses have come out and warned about a slowdown. We're seeing pressure on margins, I think, is a real talking point you're going to see coming out of this. Costs and a business's ability to pass on those costs and maintain their margins, or ideally improve them. And you've got to remember in Australia, because resources and energy stocks are such a big part of our index, they swing around the overall numbers that we hear about.
And that part will pull back this year because it had a raging year in 22.
So you're cycling against a period where coal prices, copper prices, iron ore prices, energy prices were through the roof. And that part of the market, we all know, will deliver much weaker results.
And we're actually probably cycling now the costs that have been transmitted down the production line as a result of those. So it will be harder. But knowing that too, and to your point, it becomes less value to know the aggregate than to know the parts, sectors and stocks.
Completely,
and if you look at sectors at the moment, tech's had a good run, you mentioned that. You've certainly seen resources pull off a good run. But you've had areas of weakness, real estate, healthcare, and obviously discretionary, which you mentioned as well. And there'll be some opportunities in those oversold areas.
Definitely. And as always, there'll be a lot of businesses that are struggling to deal the pressures that are out there, and there'll be those few and far in between which are getting they see an opportunity in it and they can grow their way through it. And we all know, some businesses have just got better management teams, better positions. They've invested in themselves for many years, so they can use these difficult periods to accelerate their underlying growth. I think the classic case of that was last year in tech, where we saw a massive sell-off. We saw ruthless cost cutting across the sector, and the big guys have come out of it in much more profitable shape, and which they might not have got to if they hadn't gone through that.
They need it. It can be a good medium, longer term result, can't it? Picking on a sector, this healthcare, Ben, is probably the one for me with CSL, ResMed, Ramsay have underperformed. Good long-term stocks have had a bit of weakness in earnings, a bit of a profit warning. CSL, which was just at the end of financial year, and I think that's one to keep an eye on. One from you?
Absolutely. I think that's definitely for me an area. Like I think Ramsay's an interesting one, they've obviously we are still seeing a lot of COVID issues. That's the thing we haven't spoken about. The market has grappled for 3 or 4 years now to try and work out what a business can earn as a profit, having cycled through all the COVID stuff. And, we saw a downgrade from Ansell about a week ago.
Last week,
and they talked about the surplus in all the rubber gloves and all the PVC stuff that have built up around the world. Ramsay, we know, has had a lot of issues in running its hospitals, nurse shortages, or cost pressures.
And the silver lining there is elective surgeries haven't recovered yet. And
but they're going to. Will.
And the constant ongoing needs of an ageing population suggests it's a sector we need to be certainly focused on.
And even CSL, as you look back at, what was not an enormous downgrade, but it was a downgrade. It was the pressures that we have seen build up through COVID. They're still experiencing them, and it just hasn't normalised as quickly as everyone thought it was going to. So that's really why they tapped the market's brakes and said, we can see you guys think it's going to get better this quickly, and it's actually looking, might push out in another year or so. So that's the kind of granular detail that you want to listen to.
And you'll get out of those meetings when you listen to the CEO.
That you don't see in the presentation.
And you can't read through the print, can you?
Yeah.
Excellent. That's what we're up to.
Should mention the Renault.
Oh, that's why we're here in our new little spot here. Busy at TMS at the moment with renovations on our floor, so not having meetings in the office for a little while, and we've got new digs for the TMS Insights here, Ben. So
Temporary,
and we look forward to welcoming you back a little while later in the year when the renovations are all done, which will be great.
Yep.
All right, we'll be next back to you with some updates of reports during that reporting season.